Hello and welcome to our 2020 Halftime Market Insights video. On the following video, we want to share our thoughts on what has happened in the first half of the year, particularly as it relates to the coronavirus and the impact on financial markets. We will also share our thoughts and guidance on what to expect out of the markets out of the remaining 6 months of the year. We will follow the typical agenda for these videos. We will start by talking about the U.S. economy, which will be covered by Brandon Von Felt. We will then transition to traditional asset classes, fixed income, which will be led by our Director of Fixed Income, Ben Moore, U.S. equities, which will be covered by Samantha Grant, and then non-U.S. equities, which will be narrated by David Hernandez. We will then transition to the alternatives section of our agenda. Hedge funds will be covered by Jessica Naviscus. Joe McGuane will discuss infrastructure. Derek Schmidt, our Director of Private Equity, will cover that very asset class, private equity. And last but not least, Brett Graffey will cover private credit and real estate. If you have any questions about the content on this video, we have contact information for each person at the end of this video. Now, let me hand this over to Brandon, who will discuss the U.S. economy.
Thanks, Greg. Hello, everyone. My name is Brandon Von Felt, and I cover the U.S. economy here at Marquette. Today, we will be taking a deep dive on some of the prevailing trends in the second quarter. At a high level, coronavirus cases have increased across the globe and in some parts of the U.S. as countries begin to reopen, sparking concerns of additional shutdowns. The S&P 500's one-year return is now positive, signaling a strong rebound in equity markets. Employment numbers have also been encouraging, adding 4.8 million jobs in June. In addition, the Atlanta Fed's GDP estimate was revised upwards to negative 35.5% from negative 40% in May. 3Q GDP is expected to be a sharp rebound from the second quarter, with a potential double-digit year-over-year expansion. Total COVID-19 cases across the globe have reached near 11 million, though recoveries are now larger than active cases. If we continue to see an increased number of recoveries compared to active cases, this is a signal that new infections are leveling off. Deaths have remained low, which is another positive signal for the markets. In the U.S., on the other hand, cases are trending upwards, spurred on by pockets of the country in the South and West reaching new daily highs of infections. Some states are beginning to roll back their reopenings in an attempt to control the spread of the virus. Total U.S. daily cases were above 50,000 as of June 30th. Cases have moved up since mid-June, but the good news is that deaths are trending lower. New cases have been spiking because of reopenings and protests. Recoveries remain high and deaths remain low despite an average incubation period of 1 week. There are three possibilities that could explain this. Number one, more young people are infected as older people stay safe. 2, hospital treatments are more effective now. Or 3, a mutation of the virus. It remains to be seen whether one of these is solely responsible or if it is some combination of all three. A number of vaccines are making progress and are looking optimistic. The government is funding a number of studies for treatment of COVID-19 and has made a commitment to support small businesses. In Oxford, the first human trials for a vaccine in the Western Hemisphere are showing good results so far. If everything continues to go well, a vaccine could be ready for mass distribution by as soon as the end of this year. Across the southern and western parts of the U.S., states are beginning to pause or even reverse their reopenings due to a surge in infections related to restaurants, stores, and beaches reopening. Concerns are also rising related to travelers that are going to or from high infection rate states. Controlling the spread of COVID-19 while reopening has proven to be a monumental task. Retail stores have been hit hard by the shutdowns as these thin margin companies rely on their consistent cash flows to sustain themselves. Online sales have picked up, but not by as much as in-store sales have dropped. Popular stores including Neiman Marcus, JCPenney, and GNC have all filed for bankruptcy protection. If brick-and-mortar stores continue to be closed, more retail bankruptcies are expected. Weekly unemployment claims are starting to move lower, though they are still far higher than normal. Hiring has picked back up, hopefully signaling that economic growth and spending is increasing. Overall, the most recent 1.4 million unemployment claims is a positive signal off the peak of 6.65 million claims. We will continue to monitor the weekly data in hopes that the number keeps moving lower. Employment, consumer spending, and business hiring activity continue to gradually recover. The purple line on the chart shows that small businesses have taken the brunt of the shutdown and are still struggling. Additional federal stimulus targeted towards small businesses should help mitigate some of their losses, and with any luck, will provide a way to tide the businesses over until they are able to fully reopen. With that, I'll pass it along to Ben Moore, who will be reviewing fixed income.
Hi, I'm Ben Moore, Marquette's Director of Fixed Income, and I'll be discussing our fixed income outlook. In 2Q, vaccine progress, government stimulus, and reopenings that have spiked cases but not deaths have rallied performance to nearly the mirror image of 1Q. The 10-year tumbled from 1.92% at the end of last year through the panic to end 1Q at 0.70%. In the 2Q rebound, it rose to a peak of 0.91% in early June, but ended 2Q at 0.66% amidst the resurging cases. The AG returned 2.9% in 2Q and 6.1% year-to-date. Bank loans are up 9.7% in 2Q and down 4.8% year-to-date. High yield up 10.2% in 2Q and down 3.8% year-to-date. And emerging markets debt has returned 12.3% in 2Q and negative 2.8% year-to-date. Our government debt is now nearly 160% of our GDP. Although that is as high as it has ever been, it is still lower than Japan's roughly 200% debt to GDP. Our 160% is approximately where Japan reached in 2009 as they came out of the global financial crisis. We expect that the U.S. government can issue substantially more debt because, 1, rates are so low, any incremental debt would not amount to much additional interest expense. And 2, the world will continue to depend on treasury bonds as safe havens, and demand should remain high. Fallen angels and downgrades have abated, a reassuring sign that the global economy is reopening and gradually returning back to normal. Consumer spending, job postings, and small business employment are all on the upswing. Liquidity has improved dramatically with the aid of the Fed's Treasury, MBS, municipal, investment-grade, corporate, and junk bond purchases. Despite the recession due to the pandemic, the U.S. consumer is still in moderate shape. While student loan delinquencies remain high, mortgage, HELOC, auto loan, and credit card delinquencies remain low. Spreads have tightened back in from their March peaks, but are still wider than average for plus sectors such as bank loans, high yield, and emerging markets debt. We recommend holding meaningful weights in these plus sectors now, but starting to trim as they tighten to long-term averages. We recommend considering opportunistic strategies such as stressed sub-investment grade credit, energy credit, and convertible arbitrage to benefit from the recovery. Cat bonds continue holding up well and could help add yield and diversification to traditional fixed income portfolios as well. As rates rise in a recovery or decline in a second wave scenario, these are the estimated price changes in total returns for Treasury bonds. As the economy recovers, a steepening curve might detract from a long duration stance. However, we continue to recommend maintaining core bond allocations for their principal protection. We find that certain core bond strategies have a steepener stance by being underweight duration. Certain are remaining duration neutral, while others are overweight duration as a hedge to their overweighting credit. The maturity wall for bank loans and high yield are fairly far off, but it is close for emerging markets debt, meaning EMD has a higher risk of stress in the next couple of years if the pandemic has not cleared by then. Default rates for bank loan and high yield are ticking up, but previously through the 2008 housing crisis, spread tightening started much earlier than default peaks, and we would recommend remaining invested in these plus sectors. For bank loans, there is concern of a CLO sell-off of triple Cs. There is a divergence between higher quality credits, which continue to do well, and lower quality credits, especially those in industries faring worse due to lockdowns such as energy, travel, and retail that continue to deteriorate. Security selection by fixed income strategies will be paramount in the second half. High-yield issuers' use of proceeds for acquisitions and LBOs remain low, a good sign, but for bank loan issuers, it is upticked, which is concerning. CCC and second lien issuance remains low, a positive. For key takeaways, we are seeing positive strides in vaccine development, continued government support, and low deaths despite rising cases. Current valuations remain compelling entry points for fixed income, and spreads won't remain at these attractive levels forever. Core bonds have low yields but provide principal protection in case of a second wave or low vaccine efficacy. They have limited upside if rates rise or the curve steepens. High yield and bank loan spreads are still wider than average. They exhibit moderate fundamentals, and bank loans have CLO technical concerns. EMD spreads are still wider than average and also exhibit moderate fundamentals. Their cases will lag the US's, but spreads will follow vaccine progress.
Hi, I am Samantha Grant, and I will review U.S. equities. We ended the last bull market with a record-breaking decline and possibly started a new bull market with an equally startling rise. The S&P 500 rose 20.5% in the second quarter and is up 38.6% since the market trough. This was the best quarter since 1998 and the best market rebound ever, outpacing 2009's 34.8% rally. It was a true risk-on market where every index was positive, regardless of capitalization and style. The most interesting thing about the rally was that in some ways nothing has changed from the bull market. The themes and trends that were in place at the beginning of the year are still in place and seemingly somewhat entrenched. Here we show how stocks perform by their price-to-earnings ratio, which is a gauge of a stock's affordability. Year to date, expensive stocks have outperformed cheap stocks, or in other words, growth stocks outperformed value stocks as they have for the past 4 years. Historically, bear markets bring about a change in market leadership. For instance, following the global financial crisis, growth stocks outperformed value stocks, which had led the market since the bursting of the tech bubble in 2000. So far, after the COVID-19 induced bear market, we are still waiting on a growth value regime change. This is not to say that value stocks did not show signs of life in the rebound. Coming off the market bottom, value stocks showed strong relative outperformance. At its highest point, value stocks outperformed growth stocks by 8.8% from mid-May through early June. However, the outperformance was not enough to overcome strong investor demand for the assumed safety of growth stocks. So now you can probably guess what drove the market this quarter. Yes, FANG stocks. Facebook, Apple, Amazon, Microsoft, and Google, the 5 largest companies in the world and the 5 largest companies in the S&P 500. These stocks make up 22% of the index, a level of concentration that has not been seen since the tech bubble. In the second quarter, FANG returned 35%, almost double of what the bottom 495 stocks in the S&P 500 returned. Year to date, FANG is up a mind-bending 25%, while the S&P 500 as a whole is down 3.1%. With growthy, expensive stocks leading the rebound, it is no surprise that market valuations are now above historical averages. The S&P 500 is trading near the top decile of its history. Mid-caps are trading at approximately a 20% discount to large cap, and small caps are trading at a 45% discount to large cap. Now we have an expensive U.S. equity market driven by a narrow group of large and expensive stocks, in contrast to the majority of corporations who have rescinded their forward earnings guidance. Analysts expect earnings to fall 44% in the second quarter and 22% year over year. If corporate earnings are projected to be horrible, then how can the market be up? Well, the markets are typically forward-looking, and after bear markets or recessions, stocks will often rebound before fundamentals do. In this case, investors are looking forward to 2021 earnings for valuation support. This means that there will probably be plenty of volatility in the second half of the year. While the VIX has fallen off its all-time peak, volatility is still elevated due to economic uncertainty. For example, the average daily price movement of the stock market is around 0.5%. However, since February, the average daily price movement has been 2.4%. The big question is, how long will this rally last before there is a pullback? Investors always have difficulty seeing the positive after going through a period of poor returns and high market volatility. Going forward, the largest risk is the resurgence of COVID-19 in the United States. If consumers and businesses pull back to combat the virus, it will be difficult for markets to sustain their upward trend. Eventually, investors will demand stronger economic fundamentals and corporate earnings in the present. There are also smaller risks like the upcoming presidential election and rising tensions between the U.S. and China. We will be monitoring each of these closely in the coming months.
I'm David Hernandez, and I will be covering the non-U.S. equities section. After an unprecedented first quarter, equities across the globe rallied in the second quarter. We saw the ACWI index, a global equity index, return 19.2% in the second quarter. Emerging markets outperformed non-U.S. developed markets, returning 18.1% versus 14.9%. Central banks and governments stepped up with large relief packages and stimulus measures. We also saw economies throughout the world begin to reopen. Unsurprisingly, equities rallied before we saw a rebound in global economic activity. We will review some of these data points in the coming charts, but first, let's look at some previous bear markets for the MSCI EAFE and MSCI indices. To put some context to the dramatic first quarter losses and the recent rebound, we looked at previous bear markets for the MSCI EAFE and MSCI EM indices. We defined bear markets as a 20% decline from a peak index reading. For the MSCI EAFE index, we have seen 8 bear markets the last 50 years. The average drawdown is 36%. The current drawdown for the EAFE is 34%. And that is from January 17th peak to the most recent trough on March 23rd. On average, the 1-year return from a trough is 40.7%, and the average 2-year return is 66.3%. For the MSCI EM index, which has a shorter history, there have been 4 bear markets in the last 30 years. The average drawdown is 46%. The current drawdown with the current trough on March 23rd is 34%. On average, the 1-year return from a trough is 77%, and the average 2-year return is 93%. The key takeaway here is that painful drawdowns historically are followed by strong returns over the next 12 months, especially within emerging markets. And we have started to see some of this play out. Global equities found their recent bottom near the end of the first quarter. Since then, both U.S. and non-U.S. equities have rallied. From the March 23rd lows, we've seen double-digit returns. The S&P 500 has returned 39%, the MSCI EAFE has generated a 33% return, and the MSCI EM index has gained 32%. In response to the COVID-19 crisis, central banks and governments throughout the world have taken action. Several emerging and developed countries cut their key interest rates in the first quarter. Russia and Brazil both made further cuts in the second quarter. On June 17th, Brazil lowered its rate from 3% to 2.25%, marking another all-time low. This supportive monetary policy has been paired with strong fiscal policy. For example, the Bank of England increased its quantitative easing program by an additional £100 billion this quarter. So in response to the unprecedented COVID shock, there has been unprecedented monetary and fiscal stimulus, and that has been welcomed by investors. A second phenomenon that has been welcomed by investors is improving economic data points. Composite PMIs, which are a leading economic indicator, have rebounded off their lows. For example, the US had a composite reading of 27 in April. In June, that data point came in at 47.9. The UK, Japan, and Eurozone have also come off their April lows. China, having faced the COVID crisis earlier, has already passed the 50 mark, which is a sign of economic expansion. Now, while recent economic indicators have rebounded, the IMF is concerned over future prospects of the recovery. In June, the IMF cut its 2020 global growth projection. Going back to April, it had a projection of a slowdown of 3% for global growth. In its recent June revision, it revised down its projection to 4.9% negative. The IMF expects the recovery to be more gradual than previously forecasted. They also revised down their 2021 projection from 5.8% to 5.4%. Given this, I think it's fair to question whether equity markets have gotten a little bit ahead of themselves with the continued strong equity rally. An additional data point that brings into question the continued equity rally is the rise in new COVID cases in the United States. While China and Europe appear to have the virus under control, at the end of the second quarter, the United States saw a large uptick in new cases. You also have countries like India and Brazil that have also seen pretty dramatic rises in new cases. So the big question is, how will this impact the future economic recovery? How will this impact the local economies and their ability to continue to reopen? Let's wrap things up with the takeaways for non-U.S. equities. Since the recent March 23rd bottom, broad non-U.S. equity benchmarks are up more than 30%. This has largely been driven by central banks and governments throughout the world who have stepped up with interest rate cuts as well as several other supportive stimulus measures. Now remember, equity markets tend to be forward-looking, and they tend to rebound prior to an economic recovery. Unfortunately, the IMF in June cut its 2020 and 2021 GDP forecasts, bringing into question the pace of the current economic recovery. Additionally, new COVID-19 cases have risen in the United States as well as other countries like India and Brazil. Looking forward, given the uncertainty and increased cloudiness around the current economic recovery, coupled with the strong equity returns that we continue to see, I think it's fair to have a cautious outlook on equity returns for the second half of 2020.
My name is Jessica Noviscus, and I will be reviewing hedge funds. Hedge funds concluded a volatile first half with solid gains across most sub-strategies. As a group, hedge funds are down 3.5% year to date, having recovered 70% of first quarter losses over the last 3 months. After modestly underperforming in the first quarter, equity hedge strategies bounced back strongly in the second, recovering 80% of losses and bringing year-to-date returns to negative 2.9%. Event-driven strategies continue to lag the broader group after a particularly challenging March, when merger arbitrage spreads hit levels not seen since the global financial crisis. Macro strategies, which tend to be less correlated with the broader market, are down 1.1% year to date. Credit strategies as a group ended the first half in line with the peer set, a welcome outcome given the sharp liquidity crisis experienced earlier this year. This chart tracks cumulative performance of the hedge fund universe, as measured by the HFRX Global Hedge Fund Index relative to the S&P 500. As you can see, hedge funds did a good job protecting capital as the market sold off in March. Since then, hedge funds have been recovering steadily and remain ahead of the broader market year to date through June. This chart shows how gross and net leverage of U.S. equity long-short funds has changed over the last 6 months. Gross leverage has largely tracked with the market. It peaked at 200% in late January and bottomed near 160% on March 23rd, the same day that the S&P 500 bottomed. Gross exposure ended the period in the mid-180s, which is about in line with the 10-year average. Net exposure started the year around 50%, bottomed in the mid-30s, and has now largely recovered to pre-sell-off levels. Since the bottom, this has come from a combination of long buying and short covering. This slide compares performance of the top 50 most crowded hedge fund longs to the top 50 most crowded hedge fund shorts. Two things to highlight here. First, how similarly the two groups performed during the market sell-off in March. With the market largely driven by external factors, the spread of coronavirus and its impacts on the economy, correlations essentially went to 1. While hedge funds benefited from their lower net exposures, this was a tough backdrop for stock pickers. Second, since the bottom, the most crowded shorts have outperformed the most crowded longs, with the shorts rebounding 67% versus the longs up 54%. This has been another headwind that hedge funds have had to overcome. This chart tracks the VIX index and at-the-money S&P put option premiums year to date. The VIX hit an all-time high of almost 83 mid-March, driving 30-day at-the-money put options to sell at an 8% premium, a huge increase relative to the 1% these options were selling for at the beginning of the year. While the VIX and associated option premiums have corrected since then, volatility risk premium managers are still benefiting from premiums well above average. This chart shows the percentage of loans in CLOs trading below $80, a key metric for stressed loans. At the end of March, more than 30% of these loans traded below the $80 threshold. That has since corrected to 9% as of June 30th, but the opportunity set for stressed and distressed credit investors remains more attractive than it had been pre-crisis. And lastly, final thoughts. Hedge funds have generally performed as expected this year, protecting capital on the downside, and remain ahead year to date despite the market's sharp rebound. As we noted earlier, as a group, hedge funds are down 3.5% this year, but nearly half of all hedge funds are up year to date, with the top quartile of funds up nearly 15%. The flip side being the bottom quartile of funds is down almost 20%. It makes sense to see a wider dispersion of returns across hedge funds given their broader investment mandate, and emphasizes the need for prudent due diligence ahead of investment. With that said, from here, hedge funds should be well positioned to navigate this environment, as we transition from an unprecedented equity bull market into something likely more uncertain and volatile. The flexibility of hedge funds allows them to better navigate changing conditions and create alpha regardless of what the underlying market is doing.
My name is Brett Graffi, alternatives analyst here at Marquette Associates, and I will be reviewing the current real estate market environment. It is important to remember that real estate returns are reported on a lagged basis, and we will be receiving Q2 performance data by the end of July. Looking back on the first quarter 2020, the NPI achieved a total return of 0.7%. Income contributed 1.1% to the total return, with 0.4% in appreciation. On a one-year basis, the NPI posted a gain of 5.3%, comprised of 4.5% income and approximately 0.7% appreciation. The NFI Odyssey gained 1% in the first quarter of 2020, comprised entirely by income. On a one-year basis, the NFI Odyssey was up 4.9%, comprised of 4.2% in income and 0.7% in appreciation. Despite the onset of the COVID pandemic late in the quarter, first quarter results edged positive, on track for lower returns from what we've seen in the previous few years. From a sector standpoint, industrial continued to take the lead in the first quarter with a return of 2.6%. Properties in the western regions of the country continue to lead in the first quarter with a gain of 1.1%, while the Midwest region lagged, returning a negative 0.3%. Looking at U.S. REIT performance from February 21st to the end of March, the most volatile period of the market downturn, life science, self-storage, and data center properties were the best performing property types. Alternatively, regional malls, lodging, and shopping centers were the worst performing property types, each down greater than 45% during that period. This should come as no surprise to investors, as these properties were experiencing significant headwinds prior to the COVID pandemic, while the best performing properties tend to be in industries that are experiencing growth greater than GDP and are experiencing significant tailwinds from broad market trends. Addressing near and long-term real estate impacts, as noted earlier, lodging, retail, and senior housing faces the greatest challenges. Lodging and retail has experienced an immediate drop-off in revenue, resulting in severe NOI declines. Additionally, rent and interest payments have been and will be deferred as tenants focus on liquidity and strengthening their balance sheets. Senior housing has been severely impacted by COVID due to dramatically higher mortality rates amongst older age groups, creating serious challenges for senior housing operators in the near term. The facilities are often staffed with skilled nursing professionals, which are in high demand and short supply. Furthermore, states are enforcing strict protocols regarding safety, which has increased the cost of operations. Office industrial properties have not been immune to the impacts of COVID, but their challenges are not as severe. Industrial is experiencing supply chain disruptions as a result of trade wars and decreased global demand, but these challenges turn to tailwinds over the longer-term horizon as companies look to nearshore their supply chains and increase inventories. As mentioned in the previous slide, office faces short-term tests, but the long-term performance depends on whether or not the current work-from-home trend has staying power. If remote work becomes the norm, companies will shrink their office footprint and seek more flexible work environments for employees to come and go as they please. Multifamily has been an insulated asset class as the trend of renting versus home ownership gains momentum due to increasing unemployment rates. Rental growth is expected to grow, especially in areas with young working populations and strong economic tailwinds. Looking closer at the composition of the NFI Odyssey Index, the sectors most impacted by the COVID-19 pandemic, like retail, hotels, senior housing, and student housing, represent a smaller portion of the index compared to office, apartment, and industrial. Due to the impacts of COVID-19 and the fact that many companies are still having employees work from home, the office sector is facing shifting trends as employers debate the potential of moving to a complete remote workforce, changing the future demand for office real estate. Additionally, the underlying properties in the index are predominantly on the East and West Coast, which make up over 70% of the index. While the South represents nearly 20% of the index, this area of the country is seeing strong trends in population growth and white-collar job growth. Analyzing cap rates and valuations, the current spread to the U.S. 10-year Treasury is over 300 basis points, which has only been seen 4 times since 1995. Reviewing the returns over the next 3 to 5 year periods, returns average 10.8% and 11.3% respectively. Digging deeper on previous downturns, real estate fundamentals were strong prior to the COVID-19 pandemic as supply was manageable, properties and funds were using low amounts of leverage, and were being supported by low interest rates. Furthermore, analyzing peak-to-trough performance, the S&P 500 and the NAREIT All-Equity REIT Index did not experience as deep a drawdown compared to previous market downturns. These factors should support a quicker and more accommodative recovery. Longer term, we expect a recovery to take hold, but the impact of private real estate over the next few quarters rests largely on how quickly economic activity resumes, particularly if we experience a second wave and another lockdown, and the extent to which rent payments are not made by tenants. Of particular concern are the sectors with substantial exposures to travel and retail, since people would be confined to their homes due to shelter-in-place orders. Due to the lagged nature of real estate returns, the impacts will trail the equity and bond markets, similar to previous downturns such as the Great Financial Crisis. Although short-term performance challenges loom, the long-term thesis for private real estate remains, and it should continue to be an accretive component to portfolios from both a diversification and return perspective.
Hello, I'm Joe McGuane, and I'll be covering the infrastructure section today. Infrastructure fundraising was resilient in the face of widespread economic disruption during the first quarter, but slowed in Q2 as worldwide lockdowns continued to restrict business operations. Total capital secured by infrastructure funds sank 70% on the previous quarter to $12 billion. This is the lowest amount raised in a second quarter since 2016. Furthermore, with only 15 funds reaching final close, the asset class recorded its lowest quarterly fund count of the past 5 years. Over the past 6 months, the number of funds on the road has remained consistent. At the start of the year, there were 253 unlisted infrastructure funds seeking to raise capital, and Q3 is kicking off with 246 funds raising. This could indicate that funds are still coming to market, but also suggests that some managers have struggled to meet their targets. The total amount of capital targeted has fallen to $186 billion as of July, down from $203 billion in January this year and $193 billion at this point last year. Deal count declined across all infrastructure subsectors. Utilities and conventional energy both observed the largest percentage point declines in deal activity from the second quarter of 2019. Utility deals fell from 92 to only 29 during the second quarter of this year. The telecom sector has been the most resilient by far, although it too experienced a fall in deal numbers. And finally, investors gravitated towards established fund managers as total commitments plummeted and funds took longer to close. Investors appear to be scaling back the size of their planned commitments overall, but are being selective for the right managers. The pandemic has significantly impacted deal activity in all major regions. With lockdowns starting to ease, fund managers and investors will likely look to the months ahead to revisit delayed or suspended project opportunities as supply chains begin to flow.
Turning to private equity. My name is Derek Schmidt, Marquette's Director of Private Equity, and I'll be reviewing the current market environment. Unfortunately, the data within private markets experiences a significant lag, and having just received year-end financials or fourth quarter valuations, we have yet to receive cumulative Q1 performance numbers. However, preliminary data for Q1 appears to imply performance being down high single to low double digits, mostly reflecting valuation declines, with March 31st being near the public market trough. As we previously highlighted, private equity has weathered these market downturns before. Past downturns can help inform our views on what is likely to happen in this downturn. But as we continue to caution, each downturn is unique. Thus far, during this market correction, private equity has performed as expected, experiencing a far less significant trough relative to public markets. What appears to be different this time is the rebound appears much more significant within public markets, with this downturn being more impactful and longer lasting to small businesses, and with less aggressive valuations applied within private markets relative to what the public markets have experienced in 2Q. As a reminder, these downturns in the market have been very attractive and rewarding vintages for private equity investors. The best vintages over the last 25 years have been produced during the last two market corrections. One of the reasons for this is capital becomes a bit more scarce and transactions become a bit more opportunistic, with a quality bias on good businesses at attractive entry prices. Private equity continues to provide a compelling relative value opportunity for investors. The continued disconnect between public and private market valuations is as large today as we have experienced, making it a very opportunistic time to increase private equity commitments. In May, the average discount that occurred within private market transactions relative to public market valuations was 35%. This discount is even larger for smaller transactions under $100 million, reflecting a 50% discount. We continue to believe the most attractive area of private equity remains within small funds focused on small transactions. These funds take advantage of the persistent inefficiency of small companies, and the area continues to benefit from financial stress that has been created by this pandemic. The private equity industry remains as well capitalized as it has ever been, and well prepared for this market correction. Record fundraising during recent years has positioned most private equity firms with the dry powder needed to not only support their portfolio companies, but partner with businesses either experiencing strong growth due to this correction or businesses that are more anxious to sell to an experienced partners. However, we do expect a slowdown in deal volume, which has been very common following previous corrections. This slowdown is a bit more limiting to most private equity firms as there has been travel restrictions in place. But deal volume is starting to pick up with travel expanding, and there is a lot of uncertainty depending on how significant the fall wave is within COVID. It is possible we could see a strong second half as private equity firms have been very active in having virtual discussions with potential targets. Capital calls and distributions have slowed significantly in the past downturns. This downturn has been a bit different in that many private equity firms are utilizing capital call facilities, which they quickly drew down in 2Q. This caused an increase in capital calls from LPs, but without investment activity. we would expect going forward lower than expected capital calls and distributions during the second half of the year. But again, this is uncertain based upon the response to reducing the COVID crisis. One trend we have more confidence in predicting is that private equity companies are likely to continue to extend the holding times of their businesses. These hold times have been slowly increasing, and this crisis is almost certainly to extend those due to the operational stress, the new capital these private equity firms have infused into their businesses, and the continued uncertainty being priced into transactions. This long-term focus on business value supports the benefit that private equity has in its active role in investing capital and maximizing returns for investors. So what are the private equity takeaways from the quarter? The private equity opportunity today is compelling. Now is the time to either start, increase, or accelerate private equity programs for institutional investors who can take advantage of their ability to invest in illiquid asset classes. Vintages following downturns have provided very attractive returns for investors, and we predict these vintages will be the same, providing excellent opportunities for returns. Elevated public market valuations make the relative value of private equity even more attractive today, with businesses transacting at 10 times in the private market relative to public market valuations of 15 times or even higher for the S&P 500. Strong fundraising in recent years has now slowed significantly. There has been a strong quality bias to the funds that have been able to raise capital during this environment with limited travel allowed. While fundraising in 2020 is still likely to be down, things look to be improving for the second half of the year as travel expands. While each downturn is unique and it is still too early to tell how this one will play out, private equity has performed well to date, with private equity working closely with portfolio companies, and with the capital to support further needs and make new investment, private equity has been very helpful to the private companies.
Turning briefly to private credit, my name is Brett Graffi, alternatives analyst here at Marquette Associates. Since the great financial crisis, private credit underwriting standards have weakened significantly. Today, adjustments and add-backs account for approximately 25% of overall EBITDA. Additionally, total debt to EBITDA multiples on middle market deals have reached an all-time high of 6.5 times. The resetting of valuations and the deleveraging of balance sheets as a likely outcome of the COVID-19 pandemic will lead to attractive opportunities for private credit managers going forward. In the midst of the great financial crisis, total loan volume dropped off meaningfully. As a result of the crisis and increased bank regulations, banks began to dial back their lending practices and impose higher standards on prospective borrowers. As business began to return to normal, private credit managers filled the void left by the banks and gained substantial market share as a result. Additionally, during the great financial crisis, pricing increased considerably. Post-crisis until now, yields have fallen slightly as LIBOR levels and interest rates have decreased, but private credit yields remain higher than high-yield bonds and syndicated leveraged loans. While we have not seen a spike in yields, primarily due to the lack of new deals, anecdotally, managers are seeing 200 to 300 basis point increases in yield compared to pre-COVID deals. Digging deeper on loan volume, issuance has picked up from February to March each year post-great financial crisis, but in 2020, issuance plunged 24% during that period, which has not happened since 2008. To make matters worse, middle market loan volume dropped each month in the second quarter for the first time in 15 years, making the first 6 months of 2020 completely unprecedented. Since the second quarter 2009, on a rolling one-year basis, private credit has only posted 1 quarter of negative returns, as well as posting 9 straight quarters of double-digit returns from Q2 2009 to Q1 2012, highlighting the strength of the asset class post-crisis and the consistent returns provided to investors during that period. Private credit yields continue to have greater than 250 basis point premiums over high-yield bonds and broadly syndicated loans. Strong yields and low correlations should continue to benefit middle market loans, continuing to provide positive differentiation from other fixed income asset classes. Looking at multiple cycles of data going back to 1992, private credit is the best performing asset class in a downturn. We continue to believe private credit allocations will provide investors a defensive allocation shift as the asset class has demonstrated strong downside performance and diversification benefits against other private and public asset classes. As expected, Q1 2020 was a slow quarter for private credit fundraising, with the asset class only bringing in $15 billion of new capital. Fundraising ticked up significantly, with over $30 billion coming into the asset class in the second quarter 2020, but still short of the fourth quarter 2019 total of $40 billion. The trend is expected to persist through 2020, but the industry remains well capitalized with over $250 billion in dry powder. While opportunity to finance new M&A are likely to be limited, the current market is a target-rich environment for private credit as new opportunities arise from broken deals in the syndicated market and companies look to refinance their existing debt. Private credit managers are indicating that they're still open for business in this market, but the criteria to get a deal done is higher as it will take more lender-friendly terms, higher pricing, and more collateral support. We believe that managers who have strong sourcing networks, deep experienced teams, and have exhibited discipline in their underwriting are well positioned coming out of this difficult market environment.
We would like to thank you for spending some time with us today. We hope this video has been of great use for you as you think about what to expect out of the markets for the remainder of the year and you work with your committees to make the best decisions possible for your portfolios. If you have any questions, for anyone who is a Marquette client, please feel free to reach out to your consultant for more information. You can also send us an email. For specific inquiries, please use the first email address used on this page. For general inquiries, please use the second email address listed here. Finally, in terms of next steps, please let us know any feedback. These videos are created for you. If there's a way we can improve them to improve your satisfaction, please let us know. We publish this Markets Insights video every quarter. You can subscribe to our channel for notifications when we publish it. And last, you can register for research email alerts on our website, so anything created from our research team will be automatically sent to you when it is released.